I published a new blog post last Thursday discussing 7 of my trades since my last post was published. I accidentally deleted a near completed post that discussed 4 more trades. And after that happened, I was not about to rewrite every single one of them. A link to my blog post can be found in my profile page here at YouTube. I discussed in that post selling more shares of the permanent portfolio, a mutual fund with the symbol PRPFX, and I sold just 10 shares for a profit of $405.14. Snapshots of trades and profit snapshots are provided in my blog post, as well as links to prior discussions, sell discussions primarily of the same security. This fund maintains close to a 25% allocation in gold and silver bullion, with gold near 20% of the total portfolio and silver around 5%. The amount will depend on how those assets do compared to the other assets owned by the fund. The percentage can go up or down, and if it goes too high, the fund will end up selling some gold and silver to bring the allocation back down closer to 25%. I paired the position in response to the parabolic spikes in gold and silver prices. I noted in a video published about 3 months ago here at YouTube, which I will link in the More section, that my trading history for a very long period of time, measured in decades, has always been to sell into what I characterize as a parabolic price spike in any asset class, with the only question being how to time the sales and how much to sell. I've not sold any gold and silver bullion since January 2012, and I am a long-term holder of that kind of bullion. The reason for this approach is historical, based on my early experiences as an investor that started in the late 1960s. I first experienced a massive price spike in gold and silver in the 1970s. Part of the price spike for gold was related to the government's ceasing to fix the price at $35 an ounce. If you go to the website Macro Trends, it has a chart of the gold price over the past 100 years, and for a long time, until around 1971, the gold price was fixed at $35 an ounce. And when it was no longer fixed, that provided an impetus for the price rise. And then other factors entered into the equation as to including speculation by investors. Part of the price spike for silver during that period, which I think topped out at over $40 an ounce around 1979 or 1980, was due to the Hunt brothers attempting to corner the silver market. That dates me to the fact that I can still remember stuff like that. Once tops were hit in both silver and gold in 1980, the prices collapsed. Gold topped out at around $800 per ounce, as I recall, collapsed to less than $300 by February 1985, and then started a very long period of time going nowhere that lasted until 2021, when the gold could have been bought for less than $300 an ounce. I started buying gold bullion again in 1986 and quit in either 1988 or 89, with being my last purchase. There was a similar spike early in my life as a adult investing in stocks, which was in the Japanese stock market starting around 1984 and experiencing a blowout top in December 1989, with a Nikkei 225 near 39,000, up from around 10,000 when the spike started. That index stayed below that December 1989 high until March of 2025. And the spike that started then was, I would characterize as being close to a parabolic spike in the index price. Most of the time, stock market index price bubbles are created more slowly, and I would not classify them as parabolic spikes, the Japanese market in the 1980s being an exception. And those long-term secular bear markets have rises that are more like 35 to 45 degree upward sloping angles over a long period of time, with some declines along the way. But eventually they reach a level where a 30 to 50% decline in the major index, like the S&P 500, is necessary just to bring valuations back into a more normal range. There will be massive valuation resets in many individual stocks over time due to parabolic price spikes collapsing upon themselves, but that is less the case with the major stock indexes. Stock market bull markets end with those kind of valuation resets, like the bull market that started in August 1982, and the reset started in 2020 with about a 50% decline in the S&P 500 before the valuation reset ended, with the S&P back in what I described at the time as a normal valuation range after that kind of reset. And it was similarly the case with the long-term stock bull market that started around 1950, with the catastrophic decline occurring in 1974, and that was another close to 50% decline in the S&P 500. At least with stocks, there are objective valuation criteria that an informed investor can look at to set reasonable valuation ranges. Bitcoin is another asset that has experienced a massive parabolic spike, topping out near $125,000 in October 2025. I'm not using exact numbers here. I noted that the price was down over $6,000 earlier this afternoon, January 31st, 2026, at around 1:50 Central Standard Time. Price was then at 77,435, or about a 38% decline since early October. The silver ETF collapsed yesterday by 28.54% and was down more than that intraday. For assets where there are no objective criteria to establish a reasonable estimate of what may end up being the low price after the price collapses, there's simply no way to know whether the declines in precious metals in last Friday and Bitcoin since early October has ended or will soon end with another uptrend starting, or the prices have much further to go in a downward move that only results in more losses for people buying on the dip. No one knows what will happen with the prices of those assets. Anyone that thinks they knows what will happen is delusionary, in my opinion. One of the best examples of a delusionary price spike was the rise in WTI crude oil during the worldwide 2008 near depression period. The price was near $62 a barrel and made 2007, close to where it is now in 2026, and then spiked to $140 per barrel or so by June of 2008 when the world was in a major recession. By January 2009, the price had collapsed all the way down to about $40 and went lower after that, or below where it was before the price spike started. The only news on Friday that may have had something to do with the precious metal price declines was Trump's appointment of Kevin Walsh to succeed Powell as the Fed chairman. If that was the precipitating event, it makes no sense to me, is all I can say about that. It may have caused some investors to sell based on some idea that popped into their head. But the kind of price collapse yesterday is more due to the thundering herd deciding all at once to change direction and head for the exit on the same day. I doubt that the selling actually originated with investors that own bullion, such as myself, my bullion stored in safe deposit boxes at the bank. I wasn't about to get out of my chair and go and fetch some bullion to sell last Friday, and I would have to find somebody to sell it to. But I wasn't going to, I obviously didn't do anything in response to the collapse, and I think that would be the case for almost all bullion people that actually own bullion that's stored in safe deposit boxes. The reason that this kind of event can occur, in my opinion, is because of how easy it is to sell the bullion ETFs. The selling probably got underway with massive sell orders in the silver and gold ETFs and palladium and platinum ETFs, and an ETF like GLTR, which I recently sold and have not discussed yet before the price. I sold it before the price collapse, owns silver, gold, palladium, and platinum. So then that selling was sufficient enough to trigger margin calls for people that had bought those ETFs using borrowed money from brokers. And then there would be panic selling among individual investors who could easily sell those kind of ETFs in their brokerage accounts as part of a panic reaction to what was happening. The added problem, from my perspective, is that it's simply not possible to establish a fair value range for the precious metals in Bitcoin using objective criteria. And most investors understand that to be the case. There may be people looking at charts or trying to divine the price based on the movement of the planets or whatever. But there is no objective criteria to establish fair value ranges for those kind of assets. They do not pay dividends, they do not pay interest, they have no earnings, and do not own assets that can be valued, like real estate. I would emphasize there is no way to know whether the price declines in alternatives to the fiat currencies, and that's the reason I own gold and silver bullion, is near being over or has further to go. Buying on the dips may produce a good gain down the road now, or just more losses. It's hard to know which one will happen. I suspect that the near-term reaction will be to attempt a rally Monday morning.